Good afternoon, everybody. My name is Gregor Evans. I'm the Managing Director of the Knight, and I would like to welcome you to the Knight's first committee training webinar for 2024. We would like to respectfully acknowledge the Boon Wurrung people of the Kulin Nation, the traditional owners of the land on which we are presenting this webinar today. We also extend our respects to any Aboriginal and Torres Strait Islander peoples in attendance today and the traditional custodians of the land throughout Australia. This webinar series is designed to equip committee members with the knowledge and skills needed to perform their duties and support functional, harmonious communities. Today's session is designed to help you understand the fundamentals of Owners Corporation financial management. It is a broad and important topic, and we as Owners Corporation managers are here to assist, but we also wish to empower our committees to feel confident in understanding the financial position and workings of their Owners Corporation and help make informed decisions for the benefit of their community. A few small housekeeping reminders before we get started today. Your microphones and cameras are disabled. There is the ability to ask questions via the Q&A button at the bottom of your screen. Our team are in the chat willing to help with questions, and we will also have some time for answering questions live later on during the webinar today. Thank you to those who have already submitted their questions prior to today's webinar. We have worked to address these in the presentation today. And again, for those that we haven't addressed, hopefully we can answer later on. This webinar is being recorded, and you will receive a copy of the recording and the slides after the event concludes. Okay, so today I am very pleased to be joined by Madre Clark, the Knight's Senior Owners Corporation Accountant. Madre is a CPA, so that's a certified practicing accountant, and has been part of the team since 2015. Madre has played a very important role in establishing and fine-tuning many of our internal processes, and with almost a decade of experience in the industry, there is not much she hasn't encountered. Her knowledge is vast. She is detailed and considered, and there is no one better to take us through this topic than Madre. So thank you, Madre, for sharing your expertise with us today. And over to you.
Thank you very much, Gregor, and thank you very much to everyone for taking time out of your day for being here. I know financials and accounting is probably not the most exciting topic. I will do my best to wrap it up in a bow and make it as interesting as we can, seeing that it is a bit of an unusual topic, and it's perfectly okay to not always understand it like in full. It is an area of expertise, but to have the basic understanding is really helpful. And please do not be daunted by it can be quite a mammoth thing in front of you, but always just put it back to yourself and what you do in your day-to-day life. And that's then where it becomes actually quite easy. If you put it back to yourself and see what you actually do in your own life, and you realize that you are the chief executive officer in finance of your own life, and you just branch it out a little bit, and it will be relevant to the Owners Corporation as well. Anyway, so let's go on to the first slide. There's quite a lot to cover, and unfortunately, it is a lot to cover, and it's possibly not the most interesting, but it's so important and it's so useful to know these things, even if it's something that either the penny will drop or it's something that you will remember down the line that you want to explore further. And like Gregor said, we are available for questions afterwards. And I will do my absolute best to make it as understandable as possible. I know that everybody is on different levels. Like a lot of you could be retired and have quite a high level of accounting understanding, some not so much. And I'm not sure if I will be able to cater for all, but I will do my absolute best, and I'm here for questions afterwards, and we can get everyone to the level that you would like to be and that it makes sense to you. So those are the topics that we will discuss. So let's start with the first one, which is reporting. Next slide, please. Thank you. So the annual financial statements, and as legislation requires it, it says it is the revenue and expense report and the balance sheet. To explain a bit more what it is, and I'm sure that you all know about it, a revenue and expense, it shows the income and the expenditure for the year of the property, for the financial year that the property, your owner's corporation is in. It could be the year end 30th of June, so it could be the 1st of July to the 30th of June. It could be the 1st of October to the 30th of September. So that's so that is the year that will fall over. So it's over a period that it will give you the revenue, the income, and the expense for that period. And most people refer to the revenue and expense because it's got a punchline. It tells you that is my surplus at the end. We will touch on it later down in the slides, that an owner's corporation is considered a not-for-profit entity. Because if you think about it, we're not here to make a profit. You're not like, no, okay, the electricity and the lawn mowing for the property is going to be $1,000. Let's put a bit of a profit on and let everyone pay, like, sell it. We're not Woolworths. You're not an entity wanting to make a profit. You break even. This is what we are, like the expenses are. This is what the income should be to cover all the expenses that we've predicted. So if there is something that remains, it can be a surplus or, hopefully not always, a deficit. So that is the revenue and expense, and it's like a New Year's resolution. Each year, you start fresh. A new budget, new income, new expenses. A balance sheet is the report that's got no punchline. It shows you all the assets, all the liabilities, and then it shows you what the total worth is, like what the net worth is. It's the same as going for a loan application. You've got your assets, like you can't just say, okay, I've got $20,000 in the bank, I want a loan. No, they're going to look at your overall, at a glance, they're going to have a look at everything that you represent. You've got your assets, you've got your bank account, you owe $30,000, so technically you're insolvent, yet you've got money in the bank. So you always need to look at all aspects. Or you can have $0 in the bank, but your debtors is quite high because you've just struck levies and the people are still going to make payment. Or you've got $50,000 in the bank, but you've got $50,000 worth of creditors. So it doesn't always, you have to look at it as a whole. So the balance sheet is the boring one. It's got baggage because it rolls the balances forward. And it also, you have to look at everything to have a picture of what it entails. So that is the annual financial statements, and that is what is presented at the AGM. You get additional reports. Obviously, it's the budget, which is the holy grail, and that we like everything revolves basically around the budget. And then cash flow projection reports. That is if outside of that, because everything works on the accrual, we'll touch on that as well, but the cash flow is real time. Like, this is the money in the bank, would be like, this is what we expense every month. This is basically how much money will we have in the bank after like month 5? Can we afford, should we get a cash flow, like a cash flow injection of some sort? Like, that is where that comes in, a cash flow report. Also, if you want to have extra cash, a surplus of extra cash, if you want to put it in a term deposit, that's also a cash flow projection, can be a very useful tool to predict of how much money is safe to put away, that you're not going to be stuck in month 3 and you have to pay the insurance. Another thing is there's accounting methods. It's cash versus accrual, which the reporting is done on. SCA, the Strata Community of Australia, recommends everything be done on the accrual basis, and it actually makes sense. It gives you a better understanding, a better performance gauge, because it is when any transaction, when it is incurred, like when that is when you recognize it, not when you actually receive it, because it gives you, that way it gives you a better record of who owes you, what do you owe to them. So the accrual accounting method is the best way to go. So a cash accounting, that's great for the mom and pop milk bar on the corner. Whenever you make a transactions, that is when you account for the cashing or the sales or the income of that that transaction, basically. So that's just roughly the difference between cash versus accrual. Accrual is when the income, we haven't necessarily received it, but we did strike the levy. So when it is earned and incurred, that is when we strike it. Thank you. And now further to that, further to the reporting, this, like I said, it's actually a lot, it's very simple, but there's a lot of things that kind of tie together. The OC Act has certain obligations. It says that you need to keep proper accounts that reflect the income and the expenditure. So in our terms, like a revenue and expense, assets and liabilities, which is the balance sheet. And to tie it together, it says the report should be true and fair. Like that, at that point in time, it is, or at the time of the presentation of the financials at the AGM, that it is free from error, that it is free from material error, free from bias, that it's like true and fair, that you could look at the information and that is 100% accurate. That is what the OC Act requires. It also asks that you keep a separate account for maintenance funds. And as you're familiar with our financials, we do have different categories, like the income for the operating levy, project levy, and then the maintenance plan. So we do show that separately, and that is also what the legislation requires. The OC accountant or the OC manager, we officially review the financials at year end. That is when we do our year-end adjustments. That is when we do our accruals. We account for any prepayments. So that is at year-end, just before you present the financials at the annual general meeting. And that is also what the legislation requires and what also the contract of appointment says, that we present it as at year-end, that we make all those adjustments. To take it further, the reporting is auditing of the accounts is like, it depends on the tier of the owners corporation, and it's recent legislation. Normally it used to be a prescribed owners corporation. That terminology completely fell away. It is now basically if it is a tier. And on the right hand side of the slide, you can see there that there's a tier 1, which is 101 and more knots. They must have their financials audited by an independent auditor. Tier 2, you've got the option to have it reviewed by an independent, like establishment, and normally it is an auditing firm that has that services. And then the difference between an audit and a review, it's basically the scope of the works that gets done, the scope of the testing that the auditor does. With an audit, they follow auditing principles, which is quite stringent. Like it says, like they look at the overall financials, they put a gauge on it, like what is considered material, what is not, and then they do significant testing. So it is to provide, the end result is to provide reasonable assurance that the financials are true and fair. So that's an independent person then testing every single, like not every single thing, but quite a big sample of information to see if that is treated accurately, and if they can say with a good conscience that it is true and fair. A review is a bit lesser than that. That's just, I actually wrote it down. They said that it is limited assurance. They do follow review, the review, did it escape me now? Review standards. You follow review standards because it is quite separate. So it's review standards that they follow, and it gives you a lesser, and they also do a lesser test of items, but it's still good to have it done. And but as like tier 2, that is what they require. And also because they test less and there's limited assurance that is given, it's also not as costly as a full audit, because a full audit, more work is done, more risk is taken by the auditor for saying, yes, it's free from any material misstatements. They also test the internal controls. So by default, they test the knight's internal controls. So when you have an audit done and everything is tip-top, you know that everything is within reason tip-top. And then just like further on the tiers, like tier 3 to 4, you're not required to have it audited or reviewed, but you can always opt to have it done if you should be so inclined. And then, sorry, thank you. Sorry, Ella. And then the approval of the financial statements, that is done at the AGM. That is done at the owner, like when the owner says everyone can be approved this, everyone raise their hands. So that is then the owner's obligation at the AGM. However, most likely 99% of the time, the committee would have received copies of the year-end financials for your review and for your perusal, for you to ask the questions which may come up at the AGM. That is then the time where you can go and sift through it, get your questions ready, if you should have any, and then you are more prepared if you feel like to answer any questions. If someone grabs you in the hallway and gives you a question, that you are prepared. So next slide, thank you very much. And another thing about reporting, and this is quite a bit more of a technical one, and it's also part of the recent legislation. It gives you the Australian Accounting Standards Board gives you two options of how to present financials. And it caused quite an upheaval within the OC industry, because suddenly a special purpose, like everything used to be special purpose, and suddenly they threw in the word general purpose report. And I Googled, I wanted to put the actual definition of a general purpose report. And it was just special purpose report means anything that's not a general purpose report. That's the definition of a special purpose. And then general purpose report is, in layman's terms, it's if you are a reporting entity and people are reliant on your reports because they do not have access to the information easily. And I'll break that down now a little bit more, further down. So think of BHP Billiton or even Telstra. Let's say you are a shareholder. You can't really come knocking at the reception door and say, look, you want to review the last few invoices that they've paid. They will probably frog march you with the security out of there. So that kind of say Telstra, and to give them that as an example, Telstra and BHP Billiton, they will be general purpose reports. They are a reporting entity. You do not have easy access to the reports, whereas special purpose report, like people like the Owners Corporation, you can come and knock here on the knight's door. Our lovely receptionist will tell you hello, offer you some coffee, and you can come and ask the necessary questions if you should have so. Just to that's a very basic example, but that's to give you an indication. And then whether you are general purpose report or special purpose report is the reporting entity. Just to see what the legislation says, it's whether there's a separation of owners and control. Like the shareholders of BHP Billiton, you don't really have access to it. There's quite a deep separation. Whether if the entity is of economic or political influence to society, absolutely, probably. To us, it feels like they're the center of our universe because it's our homes, it's where we spend our time, it's what we dedicate our time to. But no, it does not have an influence. If you should sell 5 lots, it's not going to cause the stock exchange to crumble. The financial characteristics, we've got levies that comes in, we've got expenses that goes out. We don't really have financial instruments and all the high-end stuff that you would expect, a subsidiary, intercompany changes and reporting and all of that. So that gives you an indication that an OC is definitely not a reporting entity. And typically, I still need to encounter an OC that is a reporting entity, but most owners corporations are non-reporting entities and prepare special purpose reports. And the Owners Corporation Act allows for either. Special purpose reports are simplified. It gives you the necessary information that you as an owner, as a committee, member require you, like, it gives you sufficient information to make the necessary decisions for the owners corporation. You do not need extensive disclosures. However, a general purpose report, that is when you specify that you are adhering to accounting standard 1, 7, all of that. It's not necessary for an owners corporation. So again, SCAs, the Strata Community of Australia, this is their preferred route to go, special purpose reports. If you should wish to make something a bit more clear, you can add disclosure to it. You could add in your notes at the AGM, you could always add something to it and say, look, just making you aware, whatever you feel is necessary to point out to the owners who are not there. Next slide, thank you. All right, the tax obligations. This is also the main 2 tax obligations that you should have is goods and services tax. If you qualify, if the owners corporation is over the tax threshold, the GST threshold, then you would have to register for GST. I will go along the points of the slides just to make it a bit easier. Goods and services tax, it's a broad-based tax of 10% on most goods that we have, except water, sewage, milk, anything that basically comes from the earth. Stamp duty, if I can now think of it. So 10% on most of the goods. So and to add to the like where things sometimes get confused with or I should a bit convoluted with the owners corporation. ATO has got us as not-for-profit organisations for GST and for-profit as a company for tax purposes. So they sometimes they don't really know which hole to put a strata into. But anyway, an OC is considered a not-for-profit organisation for GST purposes. It kind of makes sense because we're not there to make a profit, we are there to break even, or if money should stay, like if there should be a bit of a surplus, it's there as a surplus for a rainy day. You need to register for GST. If your annual turnover is more than $150,000, which is the threshold, or if it looks likely that it is going to be over $150,000. So that's the threshold, and that is the key to when you should register for GST. Once you pass the threshold, you have to register within 21 days or face penalties and interest. I think even if you can backdate it for 4 years. I don't know what the penalties and interests are going to be like. I'd hate to find out. And then just on the other side, a for-profit business, threshold for GST is $75,000. And then what does it mean to be a GST entity? You must issue GST on your tax invoices, and anything that you purchase, you can claim the GST back as well. And what the GST, what the legislation also say, you need to put GST aside in a separate account because it's not an expense, it's not an income for the owners corporation, it's money that you kind of put to the side, that you collected on behalf of the ATO, and that you paid on behalf of the ATO. So you kind of keep that there. When you do the BAS lodgements, and 90% of the time it's quarterly BAS lodgements, that is then when you either pay it over to the ATO or you get it back from them. All right, next one. Okay, now it's the other side. It's the actual annual tax return. For tax purposes, like income tax purposes, it's considered a public, like a company for tax purposes. There's no GST threshold. So if you have $1 assessable income, you have to prepare an income tax return. Now it's then where you also need to understand what's the difference. If you get money from, like, that's where it like kind of goes into two other branches. It's assessable income is when it is non-mutual. And when they say non-mutual, it is anything, any income that comes from, and to explain it like very basic, that comes from outside of the owner's corporation. So it doesn't come from within the owners. It doesn't come from anything generated from within the owner's corporation. It comes from external. And that is non-mutual income. The most common one is term deposit interest, bank interest. If you rent like your rooftop for billboard leasing, that will be non-mutual income and you will be taxed on that. So anything that comes from outside of the owner's corporation. And then let's just quickly skip on. For other tax obligations, which is like very unlikely unless you have an actual person that you employ through the owner's corporation, that is when fringe benefits tax could also apply. And then also installment activity statements. That is also where it can apply. We're going to touch further on the annual tax, on the tax return after, like a bit further down. So let's skip to the next slide. All right, here's where I'm going on a little bit more about the non-mutual income. Non-mutual income is what we get taxed on. That is income from leasing common property, interest from investments, anything that comes from outside of the lot. It does not include your annual fees, your contributions to an extra levy, an extra reserve, special fees, special charges. It's mutual income. And then it's based on the mutuality principle, and it's the same that certain clubs, like the RSL and certain clubs are, or like a golf club, it is a legal principle because of established by case law. It's that you can't derive income from yourself. So think of it like, let's say, for instance, you go on holiday, or you're planning to go on holiday. Everyone puts $1,000 away a month so that you've got enough money for expenses and air tickets. Let's say after the holiday, $500 of that little kitty remains. You're not going to declare that as income. That's basically the same as an owner's corporation. It's like this big share house where everyone went on a holiday, and whatever remains at the end, it came from yourself. It's like it's money in a piggy bank, basically. You don't have to declare the money in the piggy bank that you put there in the first instance. All right, next slide. All right, and then different owners corporation funds. So this is like, for instance, like the different funds. You can get your operating fund, and that also the reserve, like the operating reserve, that gives the leftover. What is left over is your operating reserve, but it's your operating fund, which is your day-to-day operation of the owner's corporation. That is your mowing of the lawns. It's just to keep things going on a day-to-day basis, paying off the bills for the electricity, paying off the water bills. Long-term maintenance plan, either like fund, levy, that is long-term maintenance. That is, you've got your carpets, your lifts, and you know, like legislation says, or even you get specialists who does a maintenance plan. They say, you know what, for this kind of carpet, it's only going to last about 10 years. I would say, so let's plan on, once you've got the maintenance plan, let's plan on 10 years from now that we are going to replace the carpets or even the lift. They work it all out on lifespan and everything, and that's when they work out the maintenance plan. So it's to replace things that comes to the end of their lifespan. And then you get your projects or your capital work reserve. That is a bit different than both of the other ones. That is if you've got an actual project going on. That is if you want to, say for instance, you feel the foyer looks a bit drab, let's spruce it up with a water feature. So it's an actual upgrade. And then there can be even different, like more reserves where that can be, and it's important to kind of keep it separate, that the operating income and the operating expenses, it gives you an accurate reserve. It gives you an accurate estimate of how much it costs to operate the owner's corporation. Then the long-term maintenance plan reserve, exactly the same. It's it's important to keep it separate, because especially if the maintenance plan is adopted, you have to keep that funds specifically for the maintenance plan. And then it's just like what the legislation says there. We'd like the owners corporation is permitted to charge levies, and by law everyone is to pay. It's like to pay for the upkeep of your property, and everyone needs to contribute to that. How much, what is the levies? That is determined by the actual budget, and normally it is the OC accountant in conjunction with the owners corporation manager that does the first draft. That we sift through it. We look at all kinds of like key predictors, like what does the industry do, like what do they predict is going to be insurance, and we prepare a draft financials. And from there, like once we've got the budget and it's approved, that is then where the actual levies come from. You look at all the costs for the operating reserve, the maintenance plan, any future projects, and you work out the levies that needs to be paid on that. All right, next slide. All right, okay, so now this is also a different one that we actually get, which is quite prominent. It's when to invest money and when to borrow money. If like normal, hopefully everyone's in the situation or in the position where they can invest money. That is, if you've got a surplus, if you've kind of like like especially with the maintenance plan fund, like they normally work out, say for instance, the carpeting, it's going to be replaced in year 10, but during the year, or like during the years up until the 10th year, you are saving that money, you are receiving that money, and it's prudent to actually put it away and get better interest for it. And then that's then the question. If you've got an amount and you think it's, look, let's investigate if we can actually proceed with creating a term deposit. What options are there? That's then when you like get in touch with your OC manager, say, look, I've noticed that we've probably got about 100,000 in the bank. Like have a chat to your accounts people, have a chat like with us. Can you look if it's worthwhile putting it in a term deposit? That's then where we will then go and do a cash flow and understand the financial implications, how much we predict that it's going to, like when you're going to need that money, because the last thing you want to do is to put the money away, but something's going to happen, or you didn't take into account the operational cost or any future projects, or that there's not enough funds for a disaster of some sort. So term deposits, our system is streamlined with Macquarie Bank. Macquarie Bank is one of the very few banks who are geared towards strata, the strata industry. I've had a bank who actually refused. We had $1 million to invest with one of my owners corporations in my portfolio. We had $1 million to invest, and they actually said, no, like you don't really, they couldn't really box us. Their software couldn't box us into what we really are. And they said, no, sorry, we can't, this is not available to you. So we can set it up with other term deposits, like with other banks, the term deposits, but it can be more costly because where something is streamlined, where something is interfaced with Macquarie, it's not going to be. And the banks, other than the big four banks, typically don't deal with owners corporations. They're not really geared towards understanding where the income comes from. You tell them it's from levies and they've got no idea what you're really saying. So it's always good to know that if there's a surplus, to invest it in a term deposit. And then I'm not sure, I'm assuming everyone knows what a term deposit is. A term deposit is a deposit of a specific period of time, 3, 6, you get 1 month, but the 1 month, the interest rate is very low on there. So you get it for different specific time frames at a specific locked in interest rate. And it's a very safe and a very, it's risk-free, so compared to other investments, like where firstly you need to have a financial advisor if you want to like perhaps buy shares. It's very volatile, that kind of industry. So the quickest and the easiest way is always a term deposit. That's the standard that there is. And to also have other investments, you need to understand the actual tax implication, because it's fair enough to buy shares, but if you should sell the shares, it's going to have so many tax, and you'll have to have like probably have a tax opinion on what is going to be done, because there could be capital gains tax. It's a whole different kettle of fish. That is sometimes not worth like the extra % or two that you would have gotten more from there. If in the instance that there should be a cash flow issues, unfortunately it does happen, because sometimes the unforeseen happens. A budget only allows you to see the best you can around a corner, but you don't always see the freight train coming. And unfortunately it does happen that there should be a cash flow issue. And what do you do then in a situation like that? You can borrow money. The interest rate could be really high though, because it's in essence a loan. You can perhaps premium fund your insurance. You can strike a special levy, and you can reduce expenditure in other areas. Like for instance, if you should have, say, lawn mowing, say, three times a week, like for argument's sake, you can always look at the cost where you can save it, where it won't deteriorate or like take away from the appearance of the building. It won't cause any damage to the building. If, like, say for instance, they should only mow the lawn once a week. That's just a basic example. But that's always something to have a chat with your owner's corporation manager and have a discussion with them, and then they are always your point of contact. It just makes it easier. They will then have a chat to us, and we put our heads together, and we can come back to you with other options, or like do further investigation for you. All right, next slide, please. All right, the role of the OC accountant, and then the role, it's the same as the role as the OC management company. Our core service is that we levy the owner's corporation fees. We pay the owner's corporation contractors, we prepare the annual financial statements for presentation at the annual general meeting, and we make sure, like if there's audits, we make sure that the audit gets done, we make sure that it adheres to the requirements of the legislation. Additional services, if you need reviewed statements more than annually, there could be an additional charge, but it's always something that we can do. If you want forecasting or detailed cash flows or cash projection, and you want to do it a bit more frequent, that is something that we can have a look at. We do bespoke reporting. If you want something, a further report that is geared more towards your, like with the owner's corporation, like what your appetite is, what do you want to have a look at, what do you want to know, that you can't, or that you want to look at, that you want to identify at first glance at a report, basically. And then of course the debt collection, and then the night difference. Of course, that I think that the accounts team is the most dashing of the night. The key accounting staff is located in Australia, so if you ever should want to speak to someone, you will be able to be put through to someone here in the Caulfield office. We are qualified within professional accounting bodies. We've got about 20 years combined experience. I hope that doesn't give away any of our ages. And then the support, we provide support to the OCMs and the committees. So like I said, your point of contact will, am I going over time, Gregor?
Not at all, Madrid. Continue, please.
So we, let me just see, where was I? The accounting people, we are very boring people, but we get very excited and we can talk a lot when it comes to accounting. So I thought, because I just suddenly saw Gregor popped up, and I thought, oh my goodness, I've been speaking for too long. So the OC manager is your point of contact, but he's got a whole army of people behind him that will help him, or that will help the OC manager give you the best advice and the best support that you can, because we are here to provide support to you as well. And then internal financial controls, that's just the basics. Like, we consider it as basics. It's like standard, but unfortunately not a lot of companies do see it like that, but we've got stringent separation of duties. We've got stringent internal controls. And that's sometimes why things take a bit longer, because we've got a lot of things to check. We're working with your money. So we take our time to like double check that before we make a payment, that we make sure that we do everything correct and that we've checked everything that we can check. All right, next slide. All right, this is going to be a quick one. This is just the My Property online portal. This is available to committee members where you have 24/7 access to those reports that you see online. You can see your own statement, you can see the revenue and expense statement. All of those, I'm not going to read them all, but they are very useful to have. It's very useful if you can't sleep at night, you quickly want to have a look and get yourself ready to make sure that we're on track. That's where you can go and have a look. The only caveat there is the reports are unreviewed. It's live information. So if it was just before an owner's corporation manager went to allocate it to the correct account, you could be seeing it where it was allocated to incorrect account, or while it's still in the process of being approved, being like double checked and being put in the correct account. So that's the only caveat there, is that it's raw data and it hasn't had the final tick of approval just yet. So I encourage you, please go and have a look at the My Property online portal. It's got a lot of information. Next slide. All right, the budgets and the levies. You all know budgets. It's your spending plan based on your estimated income for the year. So, and like I said, it's a not-for-profit organization. We try and break even. If there should be a surplus or a deficit, we tweak that. We've got the historical information, and we will try and mitigate that moving forward. Unfortunately, everything increases. So it's important for the OC manager, for the OC committee, even for owners, and sometimes, unfortunately, the owners don't always want to hear it, but all the costs rises, and it's not us rising, like it's not us causing it. It's the CPI. The CPI is now, I think it's 4.1. The other, like not so long ago, it was almost hitting double digits. So unfortunately, and apart from CPI, like there's industry rises as well. So for instance, your insurance, they actually told us that we should prepare for an increase of about 30%. That could change. It's very volatile. It could change any time, actually. But anyway, levies, fees that everyone is legally required to pay. It's to cover all the expenses. If an amount should remain, it would be a fortunate surplus for a rainy day. If there should be a deficit, that's not ideal. And depending on the amount, you could consider doing a deficit levy or just to break it even again. Next slide. Yes, we are. And that was it. I think I did all right in time.
Fantastic job, Madre. Thank you very much for that detailed presentation. We do have a few questions that have come through live during the chat today. So I will pose a few to you right now. Yep. So just bear with me one moment. Okay, so we have a question regarding the transfer of money between limited owners corporations and the unlimited owners corporation on the same for the same property without. So can money be transferred between limited and unlimited owners corporations, firstly, and then additional to that, if so, do they incur any GST?
No, it's just a move. It's an out of scope thing. It's the same as you transferring money, say, from your savings account to your credit card account. There's no if it's a loan, there's no GST. If you are, for whatever reason, if there are two separate entities for GST, and they should sell each other anything for whatever reason, it would be an income. Yes, there would be GST, but if it's a genuine loan where it's transfer of income, then and you're going to pay that money back at some point where, let's say, for instance, OC1, OC2, OC3. OC3 is running short on cash. They're still waiting for the members to pay. Then you can make a loan, say, from OC1 to OC3. And there will definitely not be any GST results, but as long as you pay the money back at some point.
Okay.
Does that make sense?
Yes, it does. Thank you. Another question. So if an owner's corporation spends $100,000 on a project, we will pay $10,000 GST roughly to the supplier. Do we get that back? Overall,
Absolutely.
Does the GST that we charge owners balance the GST that we pay suppliers?
Yes, it does. Because for the income, like for the levies that you raise, let's use an example. You've got $110,000. Sorry, let me step it back. So we're creating the budget. We say, okay, it's going to be our expenses for the year. We're estimating it at $110,000. And then our break-even principle, we say, okay, then we have to register, we'll raise the levies for $110,000. So the levies you will pay, you will pay the $10,000 to the ATO. And then the $10,000 from the expenses, you will claim from the ATO. So it will net each other off to zero. The only areas where you don't get it back or you can't claim it back is the water, because water does not have GST. So that's the only place where it would make a small difference between the GST that you pay and the GST that you claim back from the ATO.
And is that only for GST registered properties? If the property isn't GST registered, then they lose the $10,000.
If they are not registered for GST, then there's no GST implication. So when they pay $110,000, you're not a GST registered entity, so you can't claim the $10,000. Sure. If you were a registered entity, you have to pay the $10,000 and you have to claim the $10,000. If you're not a GST registered entity, it doesn't matter. You're not registered, so there's no GST that comes into play.
Thank you. Alrighty. A question here from Glenn. Why are the accounts done on a pre-GST basis, not an actual cash basis?
I'm not 100% sure. Do you mean net of GST when you say pre-GST?
I'm not too sure, to be honest.
Let's go on the assumption that he means when he means with Glenn. You're welcome. If you're still here, you can just double check if I'm on the right track. But when you say pre-GST, I'm assuming you mean net of GST. It's exactly because the GST amount is not part of the income. It's not part of expense. It's money that we collect on behalf of the ATO. So I can't say, oh, $110,000, that's $110,000 income. No, 100,000 is income. $10,000 is what I owe the ATO. And it's the same with an expense. Yes, we pay $110,000, but $100,000 is the expense. $10,000 is what we that we can claim back from the ATO. So that's going to be back to zero, like that, the GST account on that. I hope I answered your question there, Glenn.
Thank you, Madre. A question from Daniel. If we have a surplus, is that considered a profit we have to be taxed on?
No, because I'm glad it's a good question. I'm glad you asked that. It's a surplus. It's not a profit and loss. Like our revenue and expense statements, that's why I call it a revenue and expense. It's not a profit and loss statement. If you were with BHP Billiton, you would say, oh yeah, we're working for a profit. We are not there to make a profit from our owners. So that surplus is based on the mutuality agreement, it's non-mutual, it's mutual income. It's income because that our owners contributed. The income and the expenses were done on a break-even point. So the surplus is for rainy day. And that is the same. The example that I used was, we're going on a holiday. I contribute $10,000. The trip, everyone in the household contributes that it's $10,000. In the end, we pay, say, $9,000 for the trip. There's $1,000 that remains. we are not going to go at the end of the tax season and declare that $1,000 in our personal tax return. No, it's money that we have that we use together, that is like part of like running our little share house. So it's definitely not taxable. The only time when something is taxable, if it's non-mutual, if it comes from outside of the owner's corporation. So when like the income that we declare, that the surplus is made up of, that is assuming that it's made up of that and that there's no other assessable income in that. But let's say for that purpose, when the income and the expense, and the income is mainly received levies from the owners, then that surplus definitely will not be taxed. It's only assessable income, and it's only non-mutual income. So any from like your billboards, if you rent out like roof space for your billboards, or if you like interest from a bank, it's external from the owner's corporation. It's not money created from within the owner's corporation.
It's a good segue, Madre, to a few more questions because they deal with this topic, quite a few, and it may be that we need to actually seek some further advice from a tax specialist rather than trying to answer them ourselves. However, let's have a look at those questions. One from David. So, hello, thank you for this information. Is income received from a VCAT resolution to recover costs involving a dispute with a neighbouring building owner taxable?
That's a good one, and I'm clever in that way because I'd rather not. It's the income tax can be quite tricky, and I would like to say are they paying for like what are they actually paying for? It's a VCAT that the neighbouring one is paying for. Can you just confirm it? Can you read it again, maybe?
Sure. Is income received from a VCAT resolution to recover costs involving a dispute with a neighbouring building owner taxable? It might be that.
What was it for? Like, that's also, you need to look at the nature and the source of it. And
let's say the neighbouring building owner caused damage somehow to the owner's corporation's property, and they're reimbursing the owner's corporation for the rectification of that damage. Do you think that would be deemed to be non-mutual income?
I speak under correction, so please don't quote me on this, but I would think that would be mutual income because it was for the operation of the owner's corp. Like it was for. It will probably have GST, yes, but it's not necessarily that it will be taxable. As in, because it's to rectify something. We've already paid for say to have it rectified, and then assuming that they are reimbursing us or that they are paying for it to be fixed, I don't think it would be taxable. But please, I do speak under correction. Please do not judge me if this is wrong. I'm a nice person.
Now, look, I think obviously it comes down to every type of situation, and we need to understand the detail of that situation to make comment. But I guess our role as owners, corporation accountants, and managers is not to provide specific advice regarding these, I guess, detailed and often complex issues. And therefore, the recommendation is the owners, corporation seek advice from an expert tax consultant.
Yes, you can always pose the question to your OC manager. The OC manager will most likely come to us, and then we've got a support behind us as well. We can ask the question, and then they can say, yep, it could be an easy answer, or it could be, gosh, there's so many things to take into account there. Best to get a formal review of the question.
Certainly. There's also a question regarding embedded networks. So again, it comes down to how the embedded network is structured and managed. Sometimes it is not owned by the owners corporation. Sometimes the owners corporation itself owns the embedded network. So whether the payment of electricity from tenants rather than owners is deemed to be non-mutual, and how that is dealt with. Again, do you have any? Have you dealt with that situation before? Any comments regarding that?
Again, I speak under correction. I can't think now of a specific example. I can't think now of a specific example, but I would say in an instance like that, it would be offset against the actual electricity expense. So I don't think it would be, I do speak under correction, but I would say it's mutual, like mutual income.
Sure. And although potentially there may be a small profit if the income exceeds the expense, and therefore it could be that there's a portion of that income, or that profit rather, that has come from the tenants rather than the owners, and therefore non-mutual.
Yeah.
But certainly in that situation, the owners corporation would need to seek advice from a specialist tax
Yeah,
accountant because
absolutely.
it's a very complex one. So
Yeah.
that would be the response there. Regarding special levies, there's a question there that is as follows. I would like to understand the process of raising a special levy, the rules around this, and what happens if certain owners are unable to pay. So I can answer that one myself. So raising a special levy, the owners corporation can do so by ordinary resolution if the amount is not twice the amount of the annual fees, and typically that can be done by the committee of management, unless the committee doesn't have the power to pass ordinary resolutions, which is rare. But a special resolution is required if twice the annual amount. There's a few exceptions to that, although. And then in terms of the rules around this that's been dealt with, but also if owners cannot pay that levy, well, it's treated the same way in terms of any other owners corporation fees. The owners have 28 days to pay, and the owners corporation may have penalty interest in place that the owner who hasn't paid must pay. And then there's a process, a debt collection process that can be followed by the owners corporation if they wish to do so. So really, it's up to the owners corporation to make the call. But there's other avenues an owners corporation consider to obtain funds, whether that's by borrowing funds. Did you touch on that in your presentation, Madre?
Yes, I
Yep.
did.
Okay. I was daydreaming at that point. Apologies. But yeah, as discussed, obviously there's borrowing of funds, but also I think you mentioned the mitigation of expenses or reduction of expenses elsewhere for the owners corporation. Okay, in terms of other questions, let me have a quick look. If there's a short-term need for cash, say prior to receiving a government rebate for a capital improvement, can that be taken from reserves, either the admin or long-term maintenance plan reserve?
I would say not from the maintenance plan, because especially if it's an adopted plan, because that money is set aside, and correct me if I'm wrong with this, Gregor, but
Sure.
that money is set aside and can only be used for the maintenance plan. It's not there to fund anything else except insurance, I believe, if it is under dire circumstances.
That's right. The monies can be used in the event of an urgent need. So to mitigate any safety issue to the property or to owners. That's only when money can be taken out of the maintenance plan reserve. Yep.
Yeah. So I would say yes, take if there's a surplus available under the admin fund, and if the costs relate to the admin fund that you need to pay, then absolutely can come out of the out of the admin fund. If it's obviously a maintenance plan cost that needs to be paid and there's surplus in the maintenance plan fund, you can use it. And a surplus is exactly that. It is a rainy day kind of surplus. It's to use when there is like when something like that happens. So for me, I'm prudent. I like to have a bit of a kitty in there, and I like to not use it and always have a bit of a buffer. But yes, I would say you can definitely opt to pass you through that tough time.
Okay, fantastic. Thank you, Madre. There are a few other questions that have come to us as well. However, we don't have time to answer them all, but we'll certainly review those questions and try and get back to the individuals that have asked them. So I just want to say thank you, everyone, for tuning in today and for sharing your questions and comments with us. And another huge thank you to you, Madre, for your time and expertise, a very detailed presentation. Thank you. And if there's any part of today's presentation you wish to revisit, keep an eye on your inbox, please, for the recording of this session. and feel free to share it with any committee members who couldn't join us today or who you think might benefit from the content. You'll also receive a survey link, and we would welcome your feedback on the contents of today or any future topics you would like for us to cover in the for future presentations. And we hope to see you again at the future webinars, and like to say thank you again for attending and enjoy the rest of your afternoon. Thank you.